Like and subscribe to our YouTube channel. Follow us on Facebook, Twitter, Instagram, heck, we're even on TikTok. We're excited to engage with you. We hope you'll join us moving forward.
Good morning, everyone. Welcome to the show. Today, I'm pleased to be joined by Stephen Roman, who's the Chairman, President, and CEO of Global Atomic Corporation. And as the name suggests, we're talking uranium today, and we're talking energy. This has been quite a stock in the last year. We're really looking forward to catching up with you and finding out about the project, the overall market, and what's going on. Welcome to the show, Mr. Roman. How are you?
Andrew, thank you very much. It's really exciting to be here. Great to be on the show, and we're very excited to talk to you about the renaissance for uranium and nuclear energy, and give your viewers, a good look at our company.
So maybe you can kind of give us. We know a little bit about uranium, but give us your take on the market. Where you think it's going in the next little while. You guys have quite a run. We've seen the market really come together in the last year. So maybe give us a little background, and then we'll talk specifically about your projects in the Republic of Niger. Yep. So please give us your suggestions, what your thoughts are.
Well, listen, I think everybody knows nuclear energy has been a big part of the world for many decades. It's in Ontario, for instance, about 70% producing electricity is from nuclear, and it's a safe, reliable way to go. Typically, the price swings are quite large. Over the years, you have these big peaks and troughs. The big peak in 2007, the price ran up to $135, $136 a pound. And then it eased off again. Prior to Fukushima, it was moving back up to the 60 to 70 pound range, dollars a pound. And of course, the key thing for any project is to have a high enough grade and low enough cost to sustain your production during the lean years, and of course, make big money during the great years. So uranium now, though, is entering, I think, a completely new renaissance with the world going net carbon zero by 2050 and everybody talking about electric cars and electric everything. There's only one way to really supply that power. Solar and wind, great. You're going to have a mix of renewables in the whole mix, let's say, of electricity production. But uranium and nuclear, I think, is going to move up to a solid 25 to 30% of the world base load power, up from about 10 or 12% today. So that means a lot of new reactors need to be built and a lot of new uranium needs to be found. So my background is in the uranium sector. My father started a company called Denison Mines Limited. It still exists today, doing some great things in Athabasca. I chose to work in West Africa. I'd been working there for many years. And really, when Niger was opening the doors for new foreign investment, I moved in and acquired 6 permit areas. And we've made a tremendous discovery there in 2010, which we can talk about today.
And so that's interesting too, because a lot of people will know Athabasca. I mean, we're Canadian, so we know that region. It's rich in uranium. Other people would know Kazakhstan, which could be a little bit more challenging. But to have in Africa, where you've got infrastructure, you have got access to European markets, that adds a unique perspective to be able to meet the demands that we're seeing, especially in Europe, France and Germany, where you can service that market directly, fairly close. And certainly with lots of infrastructure and supply chain lines that get there. Tell us about the discoveries you have and the PEA, and also the kind of upside potential that you're growing into.
Well, just to follow your point, Niger supplies 30% of France's uranium supply. So the French, former French colony, they've been mining uranium there for 50 years in a basin like Athabasca. It's called the Timrossoy Basin. And there's 2 uranium mines there that are now almost 50 years old. One of them, because of ore exhaustion, shut down in March. Our discovery is just south of their operations, about 100 kilometers. And it's the largest, highest grade uranium discovery in Africa in the last 50 years. So this is a very, very significant situation. We have 250 million pounds here, delineated by 160,000 meters of drilling. We've now moved this project into phases. So the phase 1 project will be mining an area called the flank zone. And we have a little slide here of the deposit. Andrew, if you don't mind pulling that up.
So yeah, so slide, which slide would that be again? Is it 9?
No, 5.
5.
There you go.
Perfect.
So that's a look at our current deposit. You can see it's open on strike. It's still open down dip, 250 million pounds. So what we've decided to do is really mine this initially as a phase 1 project, which you see in the red box there.
Yep.
We're going to be mining at 1,000 tons per day and producing between 4 and 5 million pounds a year of uranium. We decided, that's a good place to start as a new entrant to the market, a new developer. Don't make it too big. Don't make it too small. We think a sweet spot for us is in the 4 to 5 million pound range.
Yep.
We've got a lot of interest from utilities to support the project and buy. Niger supplied France, but also supplied other markets, including the United States.
Okay.
And so, as you said, Andrew, the supply chains are there, the infrastructure's there. We have the power line going right across our property. So we're expecting to start the underground portal excavation in January. And there's a lot of activity on site right now getting ready for that momentous day.
Yeah, and you guys have put out a kind of a projection for milestones. You're already kind of ahead of them, aren't you?
We're a little bit ahead of them, yes.
Yeah.
We're actually a fully permitted project, so there's not a lot of uranium companies that can say that.
Yeah,
so we have our mining permit, we have our environmental permit, and actually a lot of work going on at site right now. We'll have some updates for the market soon, but everything's getting geared up for the big push starting in January, which is just a couple of weeks away.
Now, I had a question that came in as well, because someone actually is an investor in Global Atomic, has made some money, and they asked, and it's a legitimate question, and I like when people ask this one, is, listen, I've made some money in this already, and like we alluded to, I think you're up 380% for the year, that's fantastic. Is that they're asking, well, should I be tapping out? Should I be getting out of this thing? Or what's the next step? And I'm glad you talked about phases, because it kind of lets them know milestones, what they should be thinking about to kind of qualify. But they're wondering, is this the time to take my money off the table because I've made some, or should I be sticking in this? So it's a bit of a loaded question, but
No, it's a really good question. It's a really good question. So this is a very large deposit. Phase 1 is about 20% of the deposit.
Wow. Okay.
This is about a 50-year mine life. So all the numbers that people are seeing out there and they're hanging their valuations on is only for that 20% piece.
Wow.
They're not taking into account the rest of the deposit. So that's why we got a 15,000 meter drill program going on right now to just upgrade that from indicated and inferred to measured and indicated. We can put that into a feasibility analysis as well. So we just came out with our feasibility study, and you've got a slide on that. But and there's also one other one I wanted to show your viewers, is just the valuation of our pounds in the ground. So compared to Athabasca projects, which are up at the $8 to $10 a pound in the ground range in their values, we're down at $1.50 to $2 a pound for a fully permitted project that's going into production. We think there's still a lot of upside here. And of course, really for your viewers, the utilities haven't gotten into the market yet. So we've had some market movement in the price because of the Sprott Physical Uranium Trust and others buying physical uranium. But once the utilities get into the market, you're going to see this price start moving. And I don't think there's going to be a down dip in the price of uranium for a long time because of the fact that now we're going to a net carbon zero economy. They're going to need more uranium, and there's just not enough of it out there.
Yes,
so you
and
can see here. Sorry, Andrew, go ahead.
Go. No, please. I was going to say it's slide 17, 18. That's the comparisons. But this slide, if you want to discuss about this one, because we're talking about pounds in the ground right now. And
yeah, well, so here you go. We did our feasibility study at $35 a pound. We thought, that was a very conservative number, particularly now that the price is about $45 a pound. You can see what that does for us. And again, this is only on that flank zone starter mine area. It's not including the entire deposit. So, you're looking at somewhere around 300 to 400 million NPV after tax at about, 40% IRR,
which is
at
huge,
a $45 price. And now, the analysts here in Toronto are talking about a $60 price in Q1 next year.
Yes.
I mean, you can see what happens to our numbers at $60. So I think for investors right now, base it on the value of the pounds in the ground, the fact that we're fully permitted, the fact that we're moving into construction phase. And we have told utilities we're speaking with, we will have Yellowcake for delivery January of 2025. We also have an agreement with our neighbor, Orano Mining, one of the biggest in the world, to direct ship ore up the road. As we're building the mine and doing development work underground, we can ship that material up and actually process it in their plant.
That's excellent.
That gives us cash flow right away. So we'd have cash flow coming from that, as well as our other business, which I didn't mention yet, in Turkey.
Yes.
We have a very solid cash flow positive operation there producing zinc. So our big customer is Glencore. We ship a high-grade zinc oxide concentrate from Turkey, from our own port facility right on the Mediterranean. And we ship it to Europe, to the smelter at Glencore. And it's a very profitable business. We have a partner, Befesa Zinc. They're the largest in the world in this kind of business. And we actually recycle waste. So we view ourselves as a green company. We do recycling. We clean up toxic waste in Turkey. We produce a high value added product with it. And of course, uranium is going to be fueling a very green economy going forward. So we're really excited about the future. If you can just put up that one slide on the valuations, if you have it there.
Yes, slide 16 and 17 there at the end. We're pulling it up right now. And I'm glad you brought up the industrial usage, because people are so fixated on the battery metal story. And hey, I love it. But you need to still power that. And that's the part that people don't think about, is the grid that we need to get up to speed. Never like
do 16 first.
Sure.
No, 16. One up. There you go. That one. That's a picture of our plant. It's a brand new plant in Turkey. We built it in 2019. So we ramped it up in 2020. It'll be paid out this year, Andrew. So this thing is making money like you wouldn't believe. At $1.50 a pound zinc. Our share of this business is worth about $250 million. So, in our market cap that you see right now, uranium is still a very small portion based on a fully permitted deposit that we have.
Yes.
I mean, we are a cash flow positive company. We're not like a typical explorer. And I think people need to take that into account.
Yes. I mean, you're quite advanced stage, plus having revenues as well. I mean, and also it's diversified to some extent, really, because with the zinc application, it makes it very unique. I mean, it's very, very compelling. And I mean, it doesn't take any arm twisting for me when I look at energy all the time, is that I never try to be too aggressive with where the market's going to be. But really, and we talked about it earlier, is you have to be looking at nuclear if you're really thinking that you're going to meet any of these targets.
Absolutely. There's just no doubt about it. And you got to look at which projects are actually going to come on stream and what's their operating costs. We are in the lowest quartile of operating costs worldwide. So this is a little bit on our zinc, just going back to 2015 on what we processed. Our old plant would do 60,000 tons a year. The new plant, 110,000 tons a year of waste throughput. And we'd produce with that waste about 60 million pounds a year of zinc in concentrate. Wow. Yeah. So this is very significant, and I think people need to be aware of it. Funny enough, with all the talks I do, most people have never heard of Global Atomics, so it's nice to get the story out there with you, Andrew.
This is very exciting. I mean, I look at a lot of different companies, but it's a treat whenever you can see one that solves so many problems. And it's great hearing stories out of Athabasca, and of course your history with Denison. That's very unique as well. But whenever you can see a pathway to a direct market in Europe and France, when I look at, like, say, the shipping issues we're having and chain of custody issues, is that someone can naturally think, okay, you've got a market that's serviceable and easily attainable from one continent to another very quickly. That's very attractive. Then rather than thinking I'm going to move supplies, well, from Kazakhstan, which could be an issue, or from northern Saskatchewan somehow over to France. So this is very compelling, and we're run out of time. But we are
too bad. I have more to say.
Well, there's so much more. This is a very interesting story. We love this space.
Yeah, listen, we have a good website. People should go on it. It's very exciting. We're entering a whole new era here for uranium, so I'd get on board.
Yeah, and reach out to me for any questions, and I'll set you up, point you in the right direction on the website, and with any contacts to people at your company, because there is going to be a lot of news flow in the next year. And I'm glad that we had the question from Jason about kind of, is the upside tapped out? And it's like, no. There's a lot of room here. We're in a small phase of lots of milestones that you're going to be able to track in the next year. And that kind of answers that question, encompassing all of your plans moving forward, and the revenue that can be had in the meantime as well. So very compelling story. And I really appreciate you coming on and telling us about it.
It was my pleasure, and we look forward to further updates as we move along.
Perfect. Thanks so much. Enjoy the rest of your day, and thanks again.
Thanks, Andrew. All the best.
Today's company presentations are brought to you by Red Cloud Financial Services and the team at Red Cloud Vancouver. Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs. Tune in every Thursday at 4:15 p.m. Eastern, 1:15 p.m. Pacific for weekly corporate presentations. For more information, visit redcloudfs.com.
Welcome back, everyone. I'm joined by George Donne, who's with Giyani. I'm going to say the name wrong, and I really apologize. With Giyani Metals, which is a very compelling and interesting story about manganese. And I know before you start going, what the heck has manganese got to do with anything? We're going to get some education here, because this is a very unique project as well, and we're very glad to have them on Digging Deeper. We thank Red Cloud for introducing us. George, how are you? You're in London, so it's a bit darker right now. How are you doing?
It's a little bit dark here. Apologies, the lighting's gone in the last hour, but yeah, no, very good. Thank you, Andrew. How are you?
Excellent. We've had a great show so far. We had a good discussion earlier on this morning, and listen, let's get right into it, because this is pretty exciting what you guys are up to. You've got a very unique manganese, which is a very niche market, but I'll let you take it away, because it is very unique, and I want you to propose what the situation is here right now.
Sure. Well, in a nutshell, Giyani Metals is developing a low carbon source of high purity manganese sulfate. And for any of your audience who probably are aware of the battery space, you may have well heard of the lithium ion cathode chemistry NCM or NMC, which is nickel, manganese, cobalt. And so everyone is aware of the issues around sourcing sufficient quantities of nickel sulfate and cobalt sulfate. But manganese sulfate, particularly the high purity form, is just as important and critical to those cathode chemistries as either nickel or cobalt. But in terms of the development of those assets, 90% of the processing capacity comes from China. It comes through sources which are not necessarily, as sustainably attractive as, a lot of the end users would like. And after all, these are major car manufacturers, they're cathode producers. There's a heavy both regulatory stress and also, a public relations stress on these manufacturers being as sustainable, as transparent, and as safe as they possibly can be. And a lot of the production of this particular material comes out of sources which are very hard to trace. And it's a market that if you are, as you've seen the forces that are acting on nickel and cobalt, it is exactly the same for manganese, but perhaps coming from an even lower development base. So on I think the second slide in that presentation, Andrew, you'll see, a little bit that chart on the right-hand side there. That's projecting essentially the supply demand dynamics over the next sort of, 15 to 20 years or so. And we're going to see two forces really particularly acting on the battery manganese market. There's obviously, just the overall growth in EVs, of which the NCM chemistries are the most prevalent at the moment and are expected to keep the market share, particularly over the next 10 years. But also within that, a lot of the battery companies and a lot of the car manufacturing companies have already highlighted issues around cobalt supply, both in terms of a cost basis and also a sustainability basis, because much of the production comes out of the DRC and it's not an easy place, to get involved in sustainable production. So in order to transition cobalt away from their cathodes, they're looking at essentially going to a very manganese rich chemistry. So you may see a couple of the bullet points there talk about this, these formulations which have been announced regarding to either what they call NMX, which is basically a 370. So it's a 3 parts nickel, 7 parts manganese formulation, or this NMC. This is the German manufacturer BASF coming out with this NMC 370 formulation, or 271. So not just is high purity manganese part of the overall battery space, but over the next 10 to 15 years, we're expecting more and more mass market EV vehicles being powered by high purity manganese as the dominant element in the cathode.
Yeah, a lot of people will remember, Apple and the Congo getting cobalt, and that became a big story splash for a very short period of time. But that hasn't gone away, and I think that's what you're addressing, is that's a very sustainable problem, or that issue isn't going away anytime soon. And it's a good mix into this movement of ESG and how important that is. And I want to reiterate too, because this all comes together, is that China is right now producing most of this manganese. And not to get political, but that's an issue on a number of fronts. On an environmental kind of standpoint, on whether they'll agree to terms or not. But two, you never really want just one player in any market. I mean, if they've dominated and have a monopoly, that's not such a great thing. So there's a number of unique situations with your project, being that it's in Botswana, which is a good jurisdiction compared to South Africa, but also because you have a pathway to market that is clearly defined, and that's it's ESG regulated, and you're not only very open to it, that's what you're basing this off of. And I think any company basing their framework off of ESG is very smart, to say the least. Yeah,
it's for us, it has to be a bottom-up approach to ESG and sustainability, because we have been in contact with a number of potential end users already. We have signed a product sharing agreement with a major OEM, and their message to us is very, very clear. You have to be producing this very high purity product, which is a battery chemical. It's got to meet the quality spec in order for us to use it in our cathodes. But you must also meet all of our sustainability hurdles, because we are not prepared. Where the regulation falls, it falls on them as the actual end user producer. So they must then ensure that all of their supply chain, all of their raw materials producers meet the sustainability standards which they are being held to. So for us, it's not just a matter of, we're going to do our best and we're going to try and conform to various, standards. If we cannot meet the sustainability criteria of our customers, we cannot sell our product.
Yeah.
So we're very lucky that these assets are based in Botswana, which is consistently ranked at the top of the sustainability charts in terms of doing business. But it's also an extremely well-regarded mining jurisdiction. They have a long legacy of diamond mining in the country. They're very well developed in terms of that, but they are very keen to diversify. So you've seen a major copper operation being built recently and coming on stream up in the Kalahari Copper Belt up in the northwest.
Yep.
But the fact that we have a diamond, that we have a non-diamond and battery metals production facility going all the way to the finished product. We're not creating a concentrate or an intermediate product. We're creating the final battery chemical all in country. It is a huge publicity for them. So they're very, very supportive. And they really know about their mining as well, which is great.
Yeah, that's what's so unique, and that got me excited about this, is that it's this vertical integration, the end user. And I'm glad that you're saying it too. We've had Jamie Strauss from Digby on the show talk to us about the critical importance that people really need to get this in, and it isn't just Andrew talking about some conspiracy of business. Those days of just lowest cost, I can just come in and just power through with the lowest cost entry to market. Those are long gone. That's not going to happen. The highest end is being accounted for and being evaluated, and they'll know exactly with blockchain where you got at each step of the way your products to make your end product, and it will matter. And I think when people really start to see this integration of all these things together, that projects that will develop, some won't, that are low cost or capex friendly, won't be made. They can't happen. This one is very unique because it can happen. You're ESG friendly, and you're ahead of the pack in a market that is very niche. And that's what people need to be excited about, is niche markets that are ineffective, or are not ineffective, but inefficient, where there's a large supply issue. You're hitting a lot of criteria that a lot of people would be at least should be keeping their eye on.
Yeah, in the end, we are a mining company, but we're also a consumer products company.
Yes.
We are supplying a particular product for a particular brand of consumer, and those consumers have specific criteria that they're looking for. Right now, if you're looking for your high purity manganese sulfate to go into your cathode, you are going to be preferring producers who are outside of China, because you want to diversify your base at the very least. You want to have the lowest carbon footprint, the highest sustainability you can. You want basically the highest transparency you can, and you can't do it much better than that than having a publicly traded company. And for those groups, you will be paying a premium for that to get hold of that product. So for us, it's a very, very good position to be in. And from the investment side as well, obviously, we're now coming to the point where we're close to finalizing our feasibility study. We are going to be having a demonstration plant, which is going to be hopefully producing test samples of product by the middle of next year. And then we go into the project financing. From the financial side as well, it's a very, very small universe at the moment of companies that are trying to do this. And the economics benefits of this project, where we are going directly from ore to sulfate, we're not producing an intermediate product. We're not producing EMM, which some of our competitors and much of the Chinese manufacturers do. We go straight to the sulfate product. Means that our cost of development is very low, our power requirement is very low, and as a result, our economics, to be honest, are far better than our immediate competition. In fact, I've been in mining finance for 20 years, and I haven't seen many projects with economics like this one, because it's a low volume, very high margin business. Our throughput is only a couple of 100,000 tons a year, but our EBITDA margin is nearly 60%.
That's huge.
So it's a great place to be strategically. It's to me, it's one of the most important strategic battery metals projects out there at the moment. But in terms of economics, it's also just a fantastic project in terms of its payback returns, in terms of what it qualifies, for ESG compliance. We're really very, very excited about what's going to happen over the next couple of months, because we've got some good things to say about continuing to expand our resource. We have the demonstration plant hopefully coming into construction very soon, and there's a lot of that product coming out of the demonstration plant will be going straight to the market. And as I said, we have an agreement already in place with an OEM to sample of our product.
That's interesting. Yes.
I mean, why would a huge global corporation like an EV company want to deal with a tiny producer like us? And it's because they see the issues, they see the problems, they see how the raw material supply chain is going to be affected, and they know that they need to be dealing with companies like us because we're going to be producing these kind of specialist materials for them, and how we fit all of their criteria in terms of location, sustainability, carbon footprint, everything.
And they get to see early on with a market cap. It's around 58 million, 60 million.
Yep, that's about right.
And here, I'll leave this for a second. They get into a company at 58 million. As it's growing, it's seeing how your plant goes for a very niche specific product, which they really want. They're going to see you doing that along the way. This is like, if you're an investor, you're looking going, oh, so they have a big player who's got their eye on them, that's very interested, is watching them build this and grow. You can't say who that is, but that's also compelling to an investor to go, ooh, okay, I can see there's an upside here. 58 million is not much of a market cap with a huge upside with a lot of margin.
Yes, and very recently we just completed a financing. So we've just raised another $11.5 million. So we're very well funded. We've now got about 23 million in the bank. So we're funded through to the end of feasibility. We're funded through to the end of construction of our demo plant. And what we'd like to be doing is actually looking at even more exploration, because we have come from a point when we started the feasibility that we had a fairly small resource. We had a life of mine of only probably about 9 years. Since feasibility started, we've doubled that, and we've continued to explore, and we've continued to pursue the Cahill ore body going south. We're also just started at our second deposit at Otse. We're going to be getting to the point where we actually have too much material to process with the existing design of the plant. Then we're looking into expansion,
growing into it.
And this is, at that point, the economics of the plant are already very attractive. It's about a $450 million MPV just on this small nine-year life of mine. You imagine expanding that, sort of beyond 15, 20 years, what that can do for the valley. Now you imagine doubling that in terms of production.
Yes.
This is where the real opportunity is. As I said, we're more of a chemicals, a consumer product company. It's about how much of that can we produce.
Yes.
And with our relatively low throughputs, it doesn't take a huge amount of tonnage expansion to start justifying why you start looking bigger. And as you've seen from the slides on the market, this balloon is inflating faster than people can pump air into it, if that's not a difficult analogy. The demand is going to be there. We're going to go from a gigawatt capacity in the EU alone. Currently I think globally it's about 75 gigawatts. In the EU, it's going to go to 300 and something by 2030.
Yeah.
It's just a drop. What we can put into the market is going to be a drop in the ocean. So there's a really great position now to capture some of that market share right at the very beginning, be a reliable partner for some of these big car manufacturers. And with margins like this, it's just a great position to be in.
Yes, and it's not a story that people are well aware of, a niche market. And I want to reiterate this, about a 58 million market cap with 22 million in cash. That's incredible. With a huge upside, a partner in the space, a big partner in the space that's watching you grow. That speaks highly to the plan, and a plan with lots of milestones to check over the next year, lots of news flow, lots happening. This is certainly one people can keep on their radar and check in with. And we definitely want to keep on checking in with you to see where are we at, how's it going. But very pleased to have you on, because this is we love this type of situation where it's a unique market. People aren't paying attention to it, except these major players. And that's what you look for. That's kind of some of the key variables to look at. So thank you, George. I really appreciate you coming on and sharing that with us.
No, my pleasure, Andrew. Absolute delight. Thank you very much.
All the best. Take care. Thanks, everyone.
Cheers. Thank you. Goodbye.